Let's discuss the banks collapsing and the mortgage rates as a result. This is Jenny Andretti with Flex Mortgage Team out of Texas, and this is your mortgage and real estate update for March 20th, 2023. So as two banks collapsed and the government was basically forced to do a pseudo bailout, the mortgage rates were actually able to benefit as a result. So we saw interest rates decline as a result last week, and the hope is that the Fed will either continue to slow down rate hikes or they will have to pause them altogether. MBS Highway's March 2023 housing survey showed a ton of buyer activity and also an improved pricing environment. Nearly 33% of people who responded to the survey said that homes were not only selling quickly, but they were selling under multiple offers. And in January, only 4% responded the same thing. That's a huge improvement. So let's talk about a short history of mortgage rate moves so that we can really help you understand. So obviously there's been a huge swing in mortgage rates over the past 12 to 14 months. And this can be very difficult for home buyers to understand, especially with so many people, especially not the experts, putting in their opinions. So in as few words as possible, let me explain. Let's talk about the relationship between inflation, bonds, and mortgage rates. Bond investors hate inflation because it erodes the value of their future fixed payments. When inflation rises, bond prices fall. And when bond prices fall, the yields on those bonds go up. And as a result, mortgage rates go up. If the US does go into a recession, the Fed will stop raising rates and might actually start cutting them. That's why bad economic news is actually good for bonds and mortgage rates. So with the economy cooling, so should rate hikes.